Okay folks, welcome back. Weekly review for week ending April 12th, 2019. Okay, next week's economic calendar. On Monday, we have a member speaking, and it's noon, so not really a whole lot of impact there for Monday. On Tuesday, we have average earnings index, high impact for London Open, for GBP, and unemployment rate. And 5 a.m. on Tuesday, we have the economic sentiment for Euro. Wednesday, London Open, high impact CPI, and PPI, medium impact RPI. All day on Wednesday, we have OPEC meetings. And then 9 a.m. New York time, GBP, we have Carney speaking, high impact. So we have to be careful with cable that day. On Thursday, we have French flash service PMI for Euro for London Open, and retail sales 4:30 a.m. GBP, high impact and credit condition survey. 8:30 a.m. New York Open, we have core retail sales, and that's going to be dollar base, high impact, and Philly Fed manufacturing index. Friday, we have a bank holiday, GBP, Euro, bank holiday, and 8:30 a.m. building permits, medium impact, and treasury currency report is tentative. Alright, so dollar index daily. We had a really small week, a very small consolidation week for the dollar index. We had a 62 pip range for the dollar index. So with a 62 pip range, we didn't have very much to talk about. Everything was kept in consolidation for the week for the most part. Moving on into a hourly chart for the dollar index, you can see that we had a reaction back here on this breaker. Swing high, buy side liquidity resting above that. Stops were rated. This is previous week, obviously. And we had a run lower, leaving in this area to be retapped with the bearish breaker. Price trades up into that. Created a sell side liquidity pool with these equal lows here. The rally into Thursday's highs. Traded softer. Came back up into a breaker. This is the mean threshold of this breaker here. Traded right up into that. Reaching for the liquidity resting below these equal lows. Almost, it was a 9 pip run, almost 10 pips below the low defined by this swing low here. And we came off of that, filling in this void. Came all the way back up into essentially rebalancing this SIBI. Moving into a 15-minute time frame for the dollar index, you can see that bearish breaker here, traded right up into the mean threshold as well. Much more definition with the sell side liquidity pool. The initial run here on Wednesday, that was a run on buy side liquidity resting above equal highs and into the breaker. Moving on over to Euro dollar, this is our daily chart. I was really wrong last week about the Euro dollar, and we may see a run up into this fair value gap right there, and we'll see what that looks like in more definition when we drop down to an hourly chart and 15-minute time frame. But we may punch up into that. We did go into this bearish order block, sold off a little bit there, and we'll look at that also when we get into lower time frames. But it's just, I don't know. It's very hard to get a read on Euro right now. It just doesn't make any sense. Fundamentally, there's no reason to buy Euro. There's just simply nothing to warrant it. There's a lot of talking heads supposedly making arguments about why the Euro can rally in these conditions against the dollar, and just, I think it's a farce. They're just reading more into nonsense, really. But let's drop down into an hourly chart. You can see a little bit more definition here. This is SIBI, sell side imbalance, buy side inefficiency. So we have that still remaining. That may be an upside catalyst for next week. We have price dropping down in here. This was the only thing that I was able to muster out of the euro. And remember, last week I built the idea that I only wanted to look for shorts. So I waited, and what I was looking at was the equal highs from this high here. There's some reason why this data is being shown so far back. So it's this high and this high here, relative equal highs. And we punched above that, right above. So this whole event that took place on Wednesday was really the only payout that I had for Euro based on last week's analysis. So while it was not the entire weekly range, and it was not the direction from the open on Sunday to Friday's close, that being consolidated to upward bullish bias that's seen here in hindsight, I didn't participate in any of the long ideas because I was focusing primarily on what was expected based on my analysis last week. So I'll talk a little bit about that when we end the analysis portion and talk about the lesson for this week. But for now, just know that we traded back up into bearish order block here, traded there and sold off. We'll look at that also. What was the mechanics behind that when we get down to a 15-minute time frame. Moving over into the 15-minute time frame, we can see there is a fair value gap that we traded up into on Thursday that created a nice little additional sell-off. But this is the Wednesday sell-off in here. So we had a run above this old high. So we had buy-side liquidity tapped here and then sold off. And I already covered last Wednesday the mechanics of the breaker, what I was trying to do there, and all of this rundown. The sell-side liquidity pool and projections below that, they were all in concert with also the hourly bullish order block, which led to me targeting the 112.30 level. In hindsight, I would have liked to have traded this one here, but I was not able to do so. I wasn't looking at the charts at the time. And we had a nice run up in here. Found some support back here at these candles. And then protraction took place. The salient point I wanted to kind of bring out and just remind you of, while I did not personally have a bullish scenario for Eurodollar last week, I was able to find profitability in the demo trades that I showed on Twitter all on Wednesday. But if we are looking for a buy-side liquidity pool that was resting in here, price did run above it and then found some support back in this area here. If we know that we have a buy-side liquidity pool that may be swept, and it's just below a big figure, 113, we know that there's going to be a significant range expansion, because once we trade to the big figure, we now have another mode of liquidity to consider, or at least another threshold of liquidity to consider. So once we hit a big figure, standard technical analysis will say, well, these are nice psychological levels. And it's nothing psychological about it. They're this highly efficient for order placement. So large institutions like to place orders around that, and a lot of commerce likes to be done around these big figures as well. So full penny moves, and that's all this really is when we're talking about a big figure, is that liquidity will also rest in layers above it in 5, 10, 15, 20, 25, 30, and as much as 40 pips above a big figure. So if we know we have a buy-side liquidity pool resting above equal highs, and we did a run here, in this area one could assume with a great deal of probability that should we trade to the big figure, they'll probably want to sweep through that run. A good number is always 15, 20 pips. I like to think of it like that all the time. Sometimes it can go as much as 40 pips beyond it, depending upon what the magnitude of the catalyst behind it. In other words, what was the injection of volatility based on? Was it economic news? Was it some kind of a terrorist attack, a war type thing, or was it something that was expected to be in terms of a specific number relative to a fundamental data release that didn't meet the expectations, and the reaction is, determined based on that? I don't like to discern fundamental data like that, because I think that price really isn't working off of that In other words, it's not a knee-jerk reaction, because the way you discount that is simply look at data that would be relatively bullish for a commodity or a currency. And while it may be determined from a fundamental basis that it should be bullish and the number comes out bullish, the market runs the other direction and goes lower. So what do you do there? They made excuses for that. Oh, they discounted the data. So it's a matter of knowing what to look for based on liquidity. Okay, so I include this here because while I was not personally bullish on Eurodollar, after this big run down here, and the target I was looking for did get reached, the limit order on the final portion didn't fill me here. I got out just 2 pips away from where I wanted to get out at based on the limit. But nonetheless, that price run from that low up to the equal high, we had a nice little retracement, moved down into a discount, optimal trade entry as well, and a London close entry. So London close right in here for your notes. I don't have it here, but this is a nice example to have for a London close example for your study journal. Price rallies up, comes all the way up to target number 2 based on the Fibonacci settings, and then again 113.20 institutional. It works around there and then finally gives up the ghost, trades back down below the big figure. Not by much. We're just very shallow below 113. So I'm watching to see if they don't want to send this up into that SIBI that we talked about on the hourly chart. And again, go back and rewind the video and you'll see what I'm talking about relative to the sell side imbalance, buy side inefficiency. So that may be a catalyst. Otherwise, if we lose this low here, we'll rebalance to this price point and then resume going sideways probably. Moving on into cable, this is our daily chart. This thing's due for a move. Now, if you look at what's going on from a classic retail perspective, we're making a descending triangle. Okay, this high draw all the way down. I was going to put it on the chart, but I just can't stand to put it on there. I might do it for Twitter. We'll see this coming week. But this low to this high and all the way like projected down, it's a perfect descending triangle. Below these lows, we have all of this area that needs to be cleaned up, in my opinion. In other words, filled back in and offered sell side delivery basically is what we're talking about. And then maybe revisit this bullish order block. It would comfort me to know that we would trade down into the 128s, the high 28s, just to fill in this area here and trade back into the order block. Now the order block actually begins back here. I don't like the wick. I don't like that so much. I want to get back into the bodies because we have this area here, which in my mind is a volume imbalance because there's no real candles inside there. It's just wicks. So IPTA will most likely want to try to come down. And if it can get below these lows at all, I could be wrong. But if it does trade below these lows, I would like to see it come back down in here and go into 128.80, 128.90 in that area. And then I'd like to see if we're going to create some kind of a bullish scenario at that moment. Moving into an hourly chart for GBP USD, we have buy side liquidity pool resting above equal highs here. We see price did in fact run above that and then receded. Initially, we had a run below these equal lows for sell side liquidity. It tapped into that one more time, running below this low here, rejected it, and traded all the way back up to this price point here. So it is a lot of back and forth consolidation going on. And I mentioned this in the passing couple weeks now that we could stay like this for a while. And it's really frustrating because folks that want to short-term trade, swing trade, or position trade, they're getting hammered. And anyone that tells you they're consistently finding swing trades in this environment and taking them down with no real losses or getting stopped out, they're lying to you. Okay, so just be mindful that these conditions, while they are frustrating, they still can be utilized for intraday scalps and day trades. It just means you have to be a lot more nimble and a lot more patient for your setups and know what it's targeting in terms of liquidity. And finally, moving into our 15-minute time frame, you can see that moving into our 15-minute time frame for GBP, you can see that we have a sell side liquidity pool resting below these equal lows still. That may be targeted, and if we do get some momentum below that, we'll look for a run below this short-term low for another layer of sell side liquidity. It feels, at least for right now, they would want to target below these lows at least. I would expect that. I'd like to see some kind of a scenario where they would gap it down right below here and then trade above the gap and then find support at the gap and then expect it to trade higher that way. Then we can get some, at least movement or displacement in cable and shake off that descending triangle. I don't need it to go down to the high 128s, but that's something I'd like to see. But if we do this scenario I just outlined here, we gap down on Sunday's opening and raid this area, creating that gap from this close on Friday and whatever we open at, trade above it, and then find some support at that or the midpoint of that gap on Sunday, then I would be bullish on cable. Otherwise, I'm bearish on cable short term, running these lows out and or the low on April 9th. All right, again, looking ahead, just as a reminder, technically speaking, we have a teaching on April 19th, which is charter member. It's price action model number 3, amplified lesson. And then we have April 26th, which is 2017 charter members only. They get price action model number 11. And again, as a reminder, why I'm a charter member now, Michael. I should be getting that. No, you shouldn't. The new charter members for 2018, they are working off of a schedule of each month you're getting a price action model delivered to you. So you're just getting the amplified lesson for model number 3. Next month it'll be model number 4 and an amplified lesson. So you're actually getting 2, whereas the other 2017 charter members are just getting model number 12. But they get the additional lesson as well that complements the initial fundamental lessons for each price action model. Which brings us to the discussion and lesson for this week. It's not a big one. It's not long and winded. But I want to talk about the contrast between long form analysis and short form analysis. Now, when we talk about long form analysis, that's like a quarterly analysis. Sitting down, doing quarterly shifts, doing the time horizon for the next 2 to 3 months. What is your expectations for the marketplace? What's my expectations for the marketplace? What are we looking for specifically? Are we looking at a bullish or bearish scenario? Are we looking for certain ideas from a COT, commitment of traders, perspective to influence the marketplace? Are we looking at seasonal tendencies? Those types of things. That's a long form analysis, top down. When we do those, okay, I can work inside of that long form analysis in opposing or contrarian manner if I'm day trading or short term trading. But it helps me knowing with the long form analysis, and again, that's a higher time frame macro top down approach. That's long form analysis. Short form analysis is me pulling up a daily chart, seeing what's the next liquidity pool or imbalance, and then formulating a trade based on an hourly chart, based on seasonal tendency and day of week and time of day, to simply go in and target intraday volatility or intraday liquidity pools. That's the only difference. Most of what you see me doing on Twitter is 99% short form analysis. I either am working within the scope of what we talk about on a week by week basis, like what we're talking about in this video here. I've given you the ideas that I'm looking for next week. Unless any of those things form, I'm doing nothing. I'm sitting still. But for Twitter, because I like to prove that the things that I teach and know and you're learning is very, very consistent. And I can sit down and find something every single day if I wanted to. But unfortunately, that brings with it the expectation that, well, if Michael's doing it, I should be doing that too. And I don't want any of you, because you're in here learning how to be consistently focused, consistently profitable, looking for things that generate your demo account in a very steady upward equity curve. You don't want a roller coaster ride. You don't want to see a lot of frequency. Okay, I've been doing a lot of high frequency models on Twitter, and while that is entertaining, it takes a great deal of experience and know-how on how to do that. and I'll talk about high frequency trading in 2020. So if you're thinking about asking me or sending me emails about that, just know that we will talk about it in 2020. The ideas that go with short form analysis is basically just what's today's bias? Are we bullish or are we bearish? And the question is going to be is how do I arrive at what the bias is? And you have to know what the daily chart is suggesting. Are we working towards a higher level liquidity pool above current market price or below? That's all I'm looking for right away for daily bias. So if we're looking towards a daily chart to run an old high or run up into a SIBI to fill that imbalance back in, those things are what formulate my short form or short form analysis daily bias. I don't have to trade within the long form analysis. For instance, if we have long form analysis that leads to the idea that, say, the British pound is bullish, it will not keep me from taking day trades that are selling short GBP if I know the day of the week, time of day, and the daily chart is indicating that there's a sell side liquidity pool that is most likely going to be tagged or probed into. I will go short based on short form analysis. Now, I'm only including this because I was questioned by one of the members from our original group in 2016, 2017, that do I always take trades based on the weekly analysis that I provide to you? And in honesty, no, I don't always stick to just that rule. I sometimes will bend those rules because if I know my short form analysis is indicating that, hey, look, there's a high probability that there's a move that may take place that would be against or counter or contrarian to what my long form analysis is indicating. Since it's a day trade or a scalp, it has really no significance, and it would not even upset the long form analysis, or the ideas or outcome that longer, higher time frame analysis would indicate. So, to make it easier to understand and put it in very layman's terms, if my analysis from a monthly, weekly, and daily perspective is bearish, I can operate in a bullish scenario on an hourly, 15 and 5-minute basis because the significance of the higher time frame, I could be day trading and scalping inside of the higher time frame bullishness. I could be shorting the corrections that would lead to a longer term setup that would be in line with my higher time frame long form analysis. Okay, so that's going to be it for this week. I will talk to you guys by way of Twitter again and by way of a midweek update on Wednesday evening. And then we'll have obviously a video next week for the charter members model number 3. So I'll talk to you then. Wish you good luck, good trading.